And 3, 2, 1. As Jerry does his
little stretches before
he does his little exercise.
Yeah.
I gotta not turn on the microphone and the camera while he's over there grunting.
Need to get back in the gym.
Yeah, when you get old, folks, you grunt more when you stretch than anything else.
More than lifting, that's for sure.
Yeah.
It hurts more.
I just cry when I lift.
I don't know where 56, how that happened, but
snuck up. When I met you, you were just a wee lad, you're so young. And
I remember I had some kind of article I did when we had the CrossFit gym. It was like how a 40-something stays fit in their 40s or whatever. And
that's not you anymore.
No.
My favorite, and I'll have to post this on our socials just because it'll make me giggle, even if it doesn't make anybody else. But Jerry and I used to do these crazy runs, and we're actually going to go do something crazy next weekend. We're doing a 20.
That's going to be my last one.
Yeah, we're doing a go ruck, just the ruck part. So a lot of people do the go rucks. They do the selection thing. We're not doing that shit. I had enough of that.
Just the ruck.
But we're doing the ruck, and just the ruck is enough. Yeah. But anyway, back in the day, we used to do these long, crazy, we would run from Gettysburg, Pennsylvania to D.C.
Team runs.
Yeah, team run. What do they call those? Whatever. It's kind of like a Ragnar that they do a lot now. But anyway, and I was looking at some of those pictures, and I was like, who are those dudes?
Yeah.
They look so young. And I felt old then.
Yeah.
that was
we were
40s.
45. It was 10 years ago.
Yeah, it was 40s, which I felt old, but holy shit. 50s are even wilder. Anyway, it's two old guys talking about being old. Nobody wants to hear that.
No,
let's talk about the market.
All right. I don't know if I want to talk about that either, but, man, you have to. It was quite a week for all kinds of reasons. So let's just get into it at the end of an emotionally draining week. So we'll do the normal economically what happened this week, and then we got to talk a little bit about post-election. The election obviously was a big deal. I would bet that the Fed meeting probably had the lowest ratings in a long time because I think people are exhausted and nobody, I won't say nobody cared about it.
Well, they felt like they already knew what was going to happen, and it is what happened, and it wasn't news.
Yeah.
The biggest news, I'm going to wait till you get to that. I'll come back.
Okay. And then, so a lot of, obviously the market's way up this week, and that's awesome. And we're not out of the woods yet. I mean, there's a lot of stuff going on in the world, and even just in the U.S. economically, and it's being reflected by Warren Buffett's current positions, which, Warren Buffett has to be the single biggest economic meme creator. Not that he creates the memes, but they get created about what supposedly he says and all that. And all I'm going to do is demonstrate his current position, and you can take that for what it is.
I always picture people walking into his office, in Omaha, with a piece of paper that they've printed out the meme.
Yeah.
Right? I don't see them emailing it to him or texting it to him.
No.
He probably does a little of that, but he's probably they'll walk in with a couple of these and look at this, boss.
Yeah,
and they'll giggle and they'll throw it in the trash or whatever. Cause I'm I doubt he cares, but it is amazing how many memes are, pieces of social media content that he's in. It's just crazy.
Yeah. And everybody takes it to the bank.
If you had to pay to use his likeness,
oh yeah,
he'd be
make
richer.
A lot of money. Yeah.
He'd be richer.
He might be rich then.
Yeah.
All right, so we talk about where he's at, and then the TSP fund charts. All right, so Monday, and of course, all this nobody really cares about any of this until the election. But on Monday, you get factory orders month over month are down, so that's not they're down 0.5% versus down 0.8 last month, so it's better, but it's still negative, but it's getting better, which is good. So S&P was down, about 0.25% on Monday. Tuesday, Redbook comes out. It's at 6 versus 5.6 the previous month, which is definitely better. Redbook is year over year, same store sales. So the economy is getting a little bit better from same store perspective. And then ISM Services PMI is the economy is basically the services side and the production side. And so as they split them up, and as long as each one of them is above 50, then the economy is expanding. So services side went up to 56 versus 54.9 last month, which was good. That was also election day. and the S&P was up 1.23%. And so this is what ISM Services has looked like for the past year. And since bottoming in June, it's been a steady rise. So the economy on the services side is definitely getting better. And then Wednesday we get, so Tuesday is the election, so the results are out Tuesday night. Wednesday, so that's obviously where you get this 2.53% up day on the C fund, but as well on Wednesday you get the 30-year mortgage rate up to 6.81% from 6.73 last week. And we're gonna talk about a chart about that. But the thing is, the long rates, right? The 10-year yield is still moving higher, even as the Fed is now, as of Thursday, did its second rate cut in this cycle. So again, I got a chart that goes to that. But so Fed keeps lowering rates, and the long bond keeps going up, which means mortgages, credit cards, car loans, all that is going to be more expensive, and it implies that inflation is going to be higher in the future. And then Thursday, you get initial jobless claims, which basically were the same as forecast, which is good, right? So not so many people losing, not more people losing their job than what they expected. So unemployment is doing good. Fed cuts rates by the quarter basis point that we expected. Statement in the press conference acknowledged inflation risk going forward. We'll get into a slide on that. And S&P is up 0.74%. And then this morning, nothing really major in economic news. The Michigan consumer confidence numbers come out at 11, but this is before 11, so we're not doing that. And then as of 10 a.m., the S&P is up 0.2. So post-election and the Fed meeting. So Republicans win the White House and the Senate. The House is still unresolved, but it looks like that's going to the Republicans also. I had a chart somewhere this week. I saw this chart that was really good, and it showed the annual return of the S&P on every possible combination. So like Republicans across the board, Democrats across the board, Republicans in the White House and split Congress, and whether it was Republican Senate or Democrat Senate, Republican House, like every possible combination. And the market definitely likes one way or another a split government. So from an economic perspective, I am definitely hoping that the Democrats take the House. We'll see, but in the big scheme of things, that will be better because it basically provides gridlock, and that's what the market likes. They don't want the government getting too involved.
Yeah, exactly. I think that's the thing. It has nothing to do with Republicans versus Democrats.
No.
So don't read into that. It's more about like if any party in the government has full control of the entire government, yep, there's nothing to keep it balanced is the right word.
Yep.
But anybody with a crazy idea can let loose, and that makes the market kind of quirky. It doesn't like that.
Yeah.
So yeah, I forgot to look today to see how close they are to figuring that out, because they still haven't. I mean, this will come out on Sunday, so maybe they'll know by then.
Maybe by then.
Yeah.
I looked this morning; it was still unresolved. So, we'll see. Inflation risk is the thing. So there are basically two sides of this. The economy goes one way or the other, right? Either we basically inflation goes way up because government spending increases, which this is what always happens. So it would have to be different this time, but government spending will add to the deficit, which will grow the debt, and eventually bond buyers will not be coming to buy our bonds. And they've been talking about that for 40 years. It hasn't happened yet. Who knows what the number has to be before other countries and big pension funds and other things don't want to buy bonds or buy it at a much higher yield than what the deficit spending can sustain. Tariffs are a big deal. There's a lot of economists that think the tariffs are going to drive inflation much higher. So we'll see what actually happens in terms of tariffs. But this stocks up, dollar up, yield up, right? This is something that we definitely gotta watch. This is a chart to put on your refrigerator.
I wonder if everybody actually does that.
As goofy, I do. As goofy as this is, okay, and it's a little bit, it looks a little bit weird, but let me just try to work you guys through it. So here's the bottom in well, this is 2020, so this is the bottom of COVID. Okay. The S&P 500 is in black. The 10-year yield is in red, and the U.S. dollar is in purple. Okay. So all you have to look at, if you start at the bottom, so the market had tanked from COVID, right? We get to the bottom, and what happens? The dollar starts falling, right? And yield is essentially trending down. That's positive for stocks. So stocks, rip off the bottom in COVID, okay? All the other times through this chart, when you're looking at it, when stocks are going up, the dollar and or the yield is going down. It's very rare where you see stocks up, yield up, dollar up. Okay, that's what in all these rectangles, that's what I did. I just pointed out stocks up, yield up, dollar up. And so what happens is, at some point it resolves. In this case, in 2021, stocks kept going up, but yield and the dollar rolled over. Okay, so that's how it resolved. It resolved with yield and the dollar going down, and stocks keep moving higher. In going into 2022, we had the same thing. We had stocks going up into the top. You got yield and the dollar both going up, but then you get yield and the dollar ripping higher, and stocks came down. Right? So it resolves one way or the other. It doesn't always resolve with stocks coming down. It's just that when this condition exists, you have to pay attention because it's going to resolve one way or the other. So we're in this environment right now. Right? You got stocks going up, yield going up, and the dollar going up. Okay, so at some point, it's going to resolve itself one way or the other. And that's all. This is like the education piece, right? I'm not trying to guess what's going to happen. I'm observing that there's an environment that can't sustain. And so if you know that this is a time to be watching, right? That's all I'm saying. I don't know which way it's going to break, but it's going to break one way or the other. Okay. So, yeah, there's the White House piece. Okay, so the Fed cuts 25 basis points on Thursday. Market moves higher. I think, if the Fed had done anything other than that 25 basis point cut, things would have been different. The market would have went sideways.
That's what everybody was expecting.
Yeah, everybody expected a quarter point cut. The press conference was pretty interesting. I mean, Powell definitely did a little bit of his homework. They asked him, does he think he's going to have a job next, in January?
That was the part I was going to bring up if you didn't.
Yeah.
Nick, I just thought it was funny because it was like you could tell he was ready for that question, and he's like, the law is the law, basically. Yeah. It is what it is.
To be honest, did Trump appoint Powell originally?
I don't remember.
I think he did. I'm pretty sure because he was after Bernanke, and I think Bernanke was around. Yeah, I'm pretty sure Trump appointed Powell in the first place. They definitely had a little spat at some point along the way, and then Biden kept him. And right now, like, Trump is all about lowering rates, like, without a doubt, and Powell is lowering rates. So it would seem like they're on the same team for at least from that perspective.
Until he's not.
Yeah, I mean, imagine being in the room and you're going, okay, look, you want me to cut rates, I'm cutting rates. If you actually want inflation to come down, you have to stop spending.
Yeah,
and he's going to be like, I can't stop spending. Like, I have to give all these cuts that I promised. Like, what are you talking about?
Yeah.
So only 60%. So this fell a lot. The odds of another rate cut in December, it was like 90%, and then it fell to 60% when Trump got in because his stuff is inflationary, and so if the long bond keeps going up, the Fed can't keep cutting. It can't be independently cutting rates when the bond market is telling you rates should be higher, not lower. So there's a big concern of inflation going forward. That's what that comes from. So this I thought was pretty interesting. If you go back, this is the bottom of 2009. So this is the week. So this is the S&P 500, a weekly chart. This is when Obama came in 2012. The S&P was down 2.43% the week of election week. And then Trump gets in 2016. The market's up 3.8% election week that year. Biden comes in. Market's up 7.32% in 2020. And then as of yesterday's close, so as of Thursday's close, S&P's up 4.26% when Trump gets reelected in 2024. So none of that is really outside of the range. What's interesting is we've been talking about this for a long time. Ordinarily, the move higher comes out of September, October kind of corrective period, right? So if you go to 2012, this is a weekly chart, so it's a little bit hard to see, but this decline right there, right? That's 2 months of decline going into the bottom, and you can see this line is the bottom of that little correction, right? So the market breaks out of that and goes higher into the end of the year and keeps on going into 2013 and 14. Same thing in 2016, right? You have this decline going into the bottom, and the market, rallies into the end of the year. Same thing in 2020. Kind of went sideways there, but you definitely had that consolidation going into the election. This year, we don't have anything like that, right? The weeks going up to the election, the market's going much higher. So a lot of people were looking at that going, okay, do you fade the Trump trade? If you think Trump's going to win, or whoever wins, if the market's rallying through the summer and into the election, there's no power, there's no kind of energy created from the pullback to launch you into the rally that we're supposed to get into the end of the year. And so it's going to be interesting to see what happens going forward, because almost always you get this little corrective period going into the election, and we didn't get it this year. And still the market went up, not anything outside of what's historically normal, but it's going to be interesting to see what happens going forward. Okay. So Warren Buffett. So all that, everything that we talked about so far is bullish, right? Definitely. But how does the smartest man on Wall Street or whatever, what is he doing leading up into the election? So this is from November 4th, so it's, recent. So Barron's article, Warren Buffett is acting like a bear. Berkshire didn't buy any stock in the third quarter, and they didn't do any of their own stock buybacks. So Warren Buffett acting bearish. Berkshire is slashing the size of the company's equity portfolio, right? Raising cash to record levels and buying back no company stock for the first time since 2018. Buffett has slashed the size of the company's equity portfolio this year by more than 25%, which in TSP speak, that means 25%. This year alone, he's moved 25% to the G fund, right? That's what that means for us, including 2/3 of its Apple stake. So Berkshire's equity holdings now total about $300 billion. Okay, so $271 billion. I actually put this in there because I went back and looked at the actual numbers. It's the article said it's now total about $300 billion. The actual number is $271 billion out of $1 trillion. So Berkshire Hathaway is worth $1 trillion. $271 billion of that is equities.
So that's 1/3.
It's a little bit less than a third, between a quarter and a third. So what does that mean? It's
2/3 is in the G fund.
Yes. Well, not exactly, but yes. So let me just
in a safe place.
Yeah, let me get down to this. So operating expenses for the business, that takes up 44% of the trillion. Okay.
Oh, okay.
So
that makes a lot more sense.
Yeah. So he doesn't have either equities or G fund like we do.
Yeah.
Half of the value of his company is in operating expenses of the companies that he owns, right? So his equity position and his cash position make up the other half of that trillion. But he is in the most cash position I think he's ever been in.
Well, what he's in a position for, right? I don't know if this is where you're going, if you're going to add this to it, but I mean, where he's in a position for is to buy.
Yes.
And so if you're not familiar with how Warren Buffett has, his philosophy, his methodologies, he's a value investor, right? So his come from has always been, let me study these companies. And again, he's buying companies, not stock, like we are. He's really buying pieces, chunks, large chunks of the company. And he does that when he believes that the company is undervalued, meaning the price that it's selling right now is way less than what it's really worth.
Yep. That's when he buys it.
That's when he's buying it. Now, a lot of people are like, well, that's the same thing as buying low and, whatever. And I'm like, yeah, kinda. Right? That's not the same as catching it on the bottom. That means that like they've done the projections for the valuation of the entire company, management, their ability to run efficient operations, like all this stuff. So what that means is it's at a point where some of that stuff can be improved really, I wouldn't say easily, but definitely in a short term. So if that stuff can be improved, it is undervalued. This is a very simplistic explanation.
That's one way of looking at it. Definitely.
Yeah. Yep. There's something they could do that would bring them up to their real value, as you would say, as a value investor. So he's out there looking for deals, right? He's looking for a company. So why is that important? And why is it? That means there's nothing out there. So what that's telling you, if you really kind of read between the lines, is he believes most of these companies are overvalued. And what he wants to see is one of two things. You can wait till it comes back down to the real value and buy a little bit, and knowing that it's going to get overvalued again.
Yep.
Right?
That's what we would do. Right.
Yeah, that's what we would do. Normally, he's going to wait till it's completely undervalued, but the same principle is if it comes down to real value, and then because of all the hype, it goes back to overvalued. Well, you won. But what you're really looking for is it goes down to undervalued, right, and you win twice. It goes to real value, it probably gets hyped. That's where a lot of this stuff is right now. And Jerry has said it time and time again, particularly with the S&P, is we go look at our C fund here in a minute that tracks the S&P. I don't know if you'll be able to see it from the weekly chart, but I think you can, that it's way overvalued right now, like compared to where it should be. You can tell that by where the moving averages are, right? And so that means that there's a lot of risk on the table. Yeah. Now that also means
doesn't mean it can't keep going higher.
100%. It doesn't mean something's going to happen, but it is a darn good indicator that you should not take your eye off of it. And when we get to the TSP charts, you'll see that. And so anyway, I mean, the fact that he's in his version of the G fund with a lot of his money has to be telling you something. Everybody wants to say he's a buy and hold investor, and that's just wrong. It's absolutely wrong.
Obviously.
He tells people that the clips that you see of him saying the average investor should be in the S&P 500 and walk away. He says that because he believes, and he's mostly right, that the average investor is not educated. And if you're not an educated investor, that's probably the best you can do. It's better than putting it in a checking account or savings account. Yeah. Put it in the S&P and just let it ride. He's saying that because he believes you're. I don't think he believes you're stupid, but he's on that side.
It's a don't bet against America kind of thing. I mean, there's all kinds of ways you can look at it.
But he's not saying that to people that are actually educated investors. That's all I'm saying. Is like that quote is is taken out of context so many times that it's so frustrating to me. It's like one of my pet peeves. It's like, nah, dude, that's not what he's saying. What he's saying is if you want to be like completely ignorant of the market, your best bet is to put it in the S&P and let it ride, and that is true. Yeah. But if you want to educate yourself, there's probably some other opportunities, Yeah. Anyway.
Yeah. Anyway, I think it's so many people follow the idea of what they think Warren Buffett is about. So every once in a while, if you can get presented with what he's actually doing.
Yeah, yeah. And what's funny is, what I think is funny is I haven't seen anything in the financial news about this, significant amounts, meaning, oh my God, Warren Buffett's mostly cash kind of thing. It'll zip past it. You'll see it in a random article, but like nobody's talking about it. Because if they did, they'd have to talk about the follow-up, which is what we just did. Yeah. Well, why is that? And then they start saying out loud things like, well, maybe it's because Meta's overvalued. Maybe it's because Tesla's overvalued. And you want to say that kind of stuff out loud because some of that has to do with they don't want to have too much impact in the market, right?
Yeah.
Because people are the market, and they can, make people stray.
I've seen some really good interviews with, long-term hedge fund guys and stuff, and Wall Street, people working on Wall Street, and they get paid to be positive. Like the reason the sentiment indicators work and you go against the sentiment is because, and being bearish is almost always wrong, because the whole system is designed to move prices higher, not lower. So if you can see all the data and all the stats in the world, and you think now is the time it's going to roll over, you probably ought to wait until it actually rolls over and then short it, because if they get paid to keep prices moving higher, not lower.
Yeah. Well, I think you said it better the other time, and this is absolutely true. I tell people this all the time about pundits on TV, whether it's financial pundits or whether it's political pundits or anything. Their job, first and foremost, is to keep things to talk about.
Yep.
Right. Second thing is usually to be positive or extremely negative. Like you want to, because why? Because that generates interaction and emotion. So a lot of this is driven by emotion, and hedge fund managers in particular, or financial advisors in particular, are going to want to keep you positive because they don't want you to take their money out of their control.
That's right.
And so if they get negative, they're like, well, I don't want you to manage it anymore then. So if your financial planner is always positive, you might want to ask them a few more questions.
Yeah.
And I shouldn't say financial planner, I mean investment advisor, because they're not always the same thing.
No. That's the same. Yep. This one we put up last week just to show it, and it resolved the other way. So what we're saying is this is the NASDAQ, right? The tech index in black and the S&P 500 in red. Okay. So at the top going into 2022, you had what's called a non-confirmation. You have the NASDAQ putting in a lower high while the S&P put in a higher high. Okay. So it's a non-confirmation. And then the NASDAQ relative strength had been falling, right? So as the NASDAQ is putting in a lower high, its relative strength is plummeting. And that leads us into the bear market in 2022. And then where we were last week, the NASDAQ had put in a double top, the black line, double top. But the S&P had kept putting in higher highs, right? And the NASDAQ relative strength was certainly declining. So it's a condition. It's not a timing tool, it's a condition. And then if you fast forward to 1 week, the NASDAQ, right, was at a double top, and it broke out this week, right? And relative strength got support at the moving average of the relative strength and starts moving higher. So it's well on the way. I mean, you could argue that you're going to extend this line like that, but the divergence is pretty much gone. You got a new high relative to this one in the NASDAQ, and so you have a new bull market going, like new relative to to this section right here. So that's awesome. Okay. TSP fund charts. So huge week for the C fund. Again, this is as of Thursday's close. If you're following along on a weekly basis, which is definitely the way to do it, if you're, if you have things going on in your life and you're managing your account on a week-to-week basis, it's very simple to be above that 20-week moving average line on a weekly basis. You're in good shape. If you're below the 20-week, the market's likely moving down. If you're above it, you're in good shape. And every once in a while, you're going to have these whipsaws, which are really annoying, but you're going to get the majority of the trend. And this was obviously a big week for the C fund. Now, if you're right now and you're going, well, if I'm not in the C fund, what should I do?
That's a much harder question.
It's a hard question, right? Because if you're going to use this 20-week moving average line as your line in the sand, and you're up here at 94.16, and the the line in the sand is 88.64. That's a big percentage move before you make a decision whether or not you're going to sell it.
Right.
There's nothing you can do about that.
But, to make it a teaching point here, what you could do, and I'll go back to the chart in a second, is add another moving average, right? That's less than 20, right? So, like, I tend to use 5 and 20, and I think you do too. And so 5 and 20 is pretty helpful. You have to realize is it will bounce through that 5 a lot, but what is really telling is when the 5 and 20 start to get close together, that might give you an indication that they're getting ready to cross, which is a bad thing. Bad thing if
it's going down.
A bad thing in this circumstance. So that would tell you, this might be a time to take some off the table or take it all off the table. So you can add just a little bit more information to what Jerry's telling you there. And we don't get into that because we're not trying to get all in the weeds in these, trying to keep it really simple. And what Jerry's pointing out, I'm just trying to give somebody that is thinking like, okay, well, do I get in? This might be a way to give you that answer. Okay, slap another one in there. It doesn't have to be 5. Here's the crazy thing is as I've learned from Jerry over the years, you can wiggle those around if you want to. Over time, you kind of find ones that work. For us, that seems to be the 520, 520 and 50, if you really want to pull back even farther.
Sure.
But my point here is that could help you make that decision as to should I get in right now. If you take that weekly chart, add a 5-week moving average to it, another line, it'll start to give you a picture of like how far it is from that. Right. If it's a long way from that, might want to wait till it gets a little closer.
Yeah, that's sort of the idea of not exactly what Buffett's doing, but it's to take that idea, right? If you're on the 20-week, the market has pulled back, and the next time it gets down to the 20-week, which it will, that's a decision point. If you're out of the market, if you're in the G fund and you've watched it come down to the 20-week, that's a time that if it breaks below it, you stay in the G fund. If it finds support at that 20-week and bounces, you're getting in.
Probably a good time to get in.
Yeah.
Those little simple lines, and I'll take it a step even further for a more basic, because I tend to not to use candlesticks when I'm making decisions like this because it looks cleaner to me. Mm-hmm. And so if candlesticks make sense to you, which of course for someone like Jerry who wants all the information, because a candlestick gives you a lot of information in one little thing. If that's information overload, just make it a line chart.
Yep.
And then you'll see it a lot clearly as to where it really is. Candlesticks are the way to go because it's a whole lot of information in there. But if it's information overload, make it a line chart. And what you end up having is 3 lines. If you go back to what I was describing, you've got the line of the
price line,
the price line, the 5-week moving average, and the 20-week moving average. Use those and see how that looks to you. See if that speaks to you, because that's what all this is about.
Yeah.
If it doesn't speak to you, it's just gobbledygook. Right. But these like what Jerry said, and we say every week, these weekly charts, you could manage your retirement, your TSP account for 30 years and do really well.
Yep.
Are you going to make every top and every bottom? Absolutely not. No, and nobody is really.
No.
But you're going to do really well.
Yeah. I mean, if you're Buffett right now and you're, what do we say, 75% of his equity, the equity side of his $1 trillion is in cash. Do you think he's crying because he didn't get the move up this week? Probably not, right? Because he's just because that only more confirms his position. He's like, that just means it's even more overvalued. I want it less. I don't want it more, right? S fund monster week. The big thing about the S fund is this: it finally got above. So it's now at a new all-time high. It's taken a long time for small caps to get back. But now we're at a new all-time high. And so it is a huge move from where the S fund closed on Thursday to where its 20-week moving average line is. And so you could easily get a pullback. I mean, the trend of the S fund obviously is something like that. So we're well outside the trend. You could easily get a pullback to here and still be within this long-term uptrend. this is where the decision points come in, right? Your personal circumstances and risk tolerance and all that kind of stuff.
And if you're trying to figure out, okay, well then which one should I be in, right? You've basically got a couple choices. You can either just be evenly distributed between the two, meaning we just looked at the C fund, it's doing great. The S fund's doing great. Okay, where should I be? Let's just say, you figured this out before it happened and you say, okay, where should I go? Well, you got a couple choices. You can be evenly distributed or in both.
Yep.
Doesn't even have to be evenly. It could be 60-40, 50-50. That part really doesn't matter as much. But generally you would say 50-50 because you don't know which one is going to go higher than the other. If you really are trying to figure it out, go to our one of our blog articles we have on ratio charts, and we also have the ratio charts I think only show up for members, but you can make them if you want to. They're not that hard, but basically a ratio chart gives you C versus S, or
whichever
which one C, yeah. S versus C. And if the S, it will tell you which one is outperforming the other. Now, if you feel like that speaks to you and makes you want to be in the S 100% versus C 100%, great. But that's how you would tell. Generally speaking, you don't know immediately.
Right.
So that's the hard part. You have to kind of let that play out. But that's the way you would figure that out.
So we've been talking about this for a while on the podcast and in the newsletters. And if you watch Tom Lee at all, he's been talking about it for months. Everybody knows the Fed was cutting rates. The expectation is that the long bond also went down, and that did not happen. The long bond is what drives the cost of borrowing money. So the idea was that the long bond would go down when the Fed started cutting rates. It's cheaper for small companies who need to borrow money to do payroll and all that. Apple doesn't need to borrow money to do operations, right? But small companies do. So when the rates go down, that's much better for small companies than it is for big companies. That's why Tom Lee and other people were saying, hey, small caps can move 50% by the end of the year versus the C fund maybe up another 10 or 15% or something. It didn't play out that way. But if you were looking at it and you were going to set up your allocation based on macroeconomic conditions, which is that would be a way to do it. But otherwise, yeah, all you can really do is look at a ratio chart and see the trend of which one's outperforming the other. Okay, iFund, and this is another way to do it. I mean, the iFund obviously is relatively underperforming right now, the C and the S fund. So you might look at this and go, why would I get in the iFund right now? Well, while the C and the S are way up here, overvalued relative to their blue 20-week moving average line, the I fund is way undervalued relative to it. So if the I fund can get above, so right now, the moving average is 43.80, and price is at 43.87. So it's just barely above, right? If it closes for the week there, it'll be back above that 20-week moving average line. And it looks like it's going to get support there at that 50 line on relative strength. So it's very possible, especially if the dollar goes down, that the I fund starts moving up. And if it starts moving up, it probably, at this point, at least for some amount of time, outperforms the C and the S fund because the C and the S fund are now way overvalued. So they end up doing like that. You know what I mean? They're all going in the same direction. It's just that the cycle is off. And the F fund. I mean, who knows? Is this the bottom? Impossible to tell right now. We're right on that 50 line. It would be great if yields stopped rising, which means the F fund would stop falling. And it would be great if that happened. Because if the F fund keeps going down, so if the F fund is going down, it means yield is going up. If yield is going up, let's say yield goes up, mortgage rates get back above 7%, it's getting ridiculous to be a human being and trying to exist on a day-to-day basis. It's one thing for stocks to keep going up, and that's great. Like, everybody loves that. But the high yield is killing people. And then the G fund, just because we can do it, it always goes up and to the right. So there's nothing special about it. It's just that the percentage move is very low. So Although if rates go up, well, no, let me rephrase that. Rates can go up. Long bond rates can go up. The G fund is much more based on what the Fed does. So as the Fed continues to cut the Fed funds rate, the G fund actually goes down. So meaning the amount that your rate of return would go down. The G fund you're never going to see the G fund line go like that. It doesn't go down by law. It will just not go up on as steep.
It doesn't go negative.
Right.
It does go down.
The amount that your rate of return can decrease.
Right. Yeah, that's a better way to put it.
Right.
Yeah.
So that's
it can decrease, but doesn't go down. Doesn't
right.
Go down.
So like
doesn't go below zero.
We're at 1863. It's never going to be 1860 again.
Right. Yeah.
Right? The line can't go down. It can be 18.630001. Right. That would be great because the rates would be basically almost back to zero. Anyway, it's a good week to be an analyst. If your side won, great. If your side didn't win, we're all in it together at this point.
Hey, at this point, it's that part's over.
Yeah.
There's no point in even worrying about it anymore. Yeah. And that's normally my advice. Like, my kids ask me, some of them are adults already, and they're just like, well, what should we do? And I'm like, you do the same thing you do with the market. You respond to it. You don't try to figure it out. You don't try to guess. And once it's happened, it's happened. So you got to respond. And so whatever is coming for the next 4 years doesn't make any more difference than what's coming for the next 10. Every day you wake up and you respond to what the world is. Yeah. That's the best way you can do it. That's the best you can do. Now, people that don't respond are the ones that get caught off guard, right? Because you're too worried about what you wish it was doing.
Yeah.
Instead of concentrating on what it actually is doing. Yeah. All of us can sit around. We could be pundits too and talk about what the next 4 years would look like. And all we would be doing is wasting your time.
Absolutely.
Because we have no clue what's going to happen.
Idea.
We, like many of you, have been in the government for a long time. We were 30 plus years. And there's one thing that I always took away from the fact that I was in the government for 30 years, both the military and federal civilian side, was that there was no way to tell what's going to happen in the next year or so. So don't try. You got to respond to what's happening. Yep. All right, guys. I hope you enjoyed the show this week. And if you did, please share it with your friends. If you have any questions, as always, you can just put them in the comment section wherever you find the video. If there's no comment section, you can always shoot us an email at support@growmytsp.com, and the support team will get it over to us. Hope you guys have a great rest of your weekend and a great week. See you later.
Out of here.